Hello everyone and welcome back to the channel. I sold out of Apple and today I want to talk about Apple's earnings report and what I thought of the report overall, the reasons I've now sold out of this position in my Trading 212 portfolio, which is a position I've held for the longest time other than almost any other stock I believe, and the mysterious stock I bought with my contributions to my stocks and shares ISA and from selling out of this position. So lots to get through, and if you're new to the channel, welcome to That Investing channel, where I invest in the best companies I can to get great returns and share all my mistakes with you guys. If you get something out of this video, then feel free to subscribe for similar content in the future. However, as always, I'm not a financial advisor, so do your own research. Let's jump straight in with Apple's earnings then. This report led to a very positive reaction from the market overall, up nearly 6% on the day. So obviously there was plenty of positives. The focal point for most investors was the record-breaking $110 billion buyback scheme, which has always been a big part of Apple's strategy in recent years to return value to shareholders and of course Mr. Warren Buffett by aggressively buying back their shares. As we can see from this chart, they have massively reduced their outstanding share count in the past 10 years, from 24.5 billion to around 15.7 billion, averaging at around about 3% overall percentage buyback each year. That's huge and one of the main ways Apple rewards its shareholders. Additionally, they raised their dividend slightly by 1 cent per quarter to 0.25 cents per quarter, which I didn't find that big of an increase, around inflation at about 4.2%, so it's not really growing, just matching inflation, but it's better than not touching that dividend at all in my opinion. Now there are a few other positives I took from this report, and that's that services aspect of the business that I think is actually one of the most promising sides of Apple alongside its innovation was growing and beating estimates. The ecosystem of Apple wants to break into this high margin services business model using stuff like Apple Pay. This is because it takes advantage of their already established widespread products to get people to use their online systems. Now this beat was marginal next to some of the bad news, but it was still hundreds of millions of dollars of a beat, from estimates of 23.27 billion compared to the achieved 23.9 billion, so around 2.7% higher than expected, which was very good and promising in my opinion, which led to an overall beat on revenue as a whole. Now I've talked about the positives, let's point to the obvious negatives. Sales down on iPhones, their main source of revenue. Sales also down on Macs as well. They've met headwinds in China, and that tough competition has left Apple with harder overall growth in these regions of the world, especially where their hardware is concerned. This, when compared to the developed Western world in terms of hardware, has shown more resilience. One thing I think Apple has going for it is its brand loyalty will eventually win out. I think people will continue to buy Apple products, and they are simply established in Western culture now, and people are heavily invested in that mindset. So I took this as quite a mixed report, but as I said before, I sold my shares and my position. So why did I do this when I'm mentioning a lot of good points? Well, it's not because I think Apple is a dying business or a particularly bad investment. I actually think Apple is among the best companies in the world. My reason to sell was more due to my own margin of safety and assessments on the next 5 years or so growth in terms of free cash flow. As I talked about earlier, I bought this one around 10 to 11 months ago and added to it a few times after that when I was just getting started with investing. I didn't consider any margin of safety or intrinsic value to a company. I didn't think about the free cash flow growth or even the revenue growth on the top line. I simply wanted to own Apple. And I held it because it made sense. I wanted to be a long-term investor, but I've also come to believe that my original investment of over £1,500 left little to no margin of safety for how Apple was valued at the time. And with the current estimates in growth for the next couple of years, I believe there is actually better valued opportunities on the market that offer better options for growth than Apple do right now. So my investment was valued at about £1,623, and when I sold it I made a small profit of around £25 at around about $184 per share. Obviously this wasn't a very good return for how long I've held on to this company, and some people would probably be justified in saying that I've just lost my nerve investing and pulled out of Apple before it can really perform. However, I've changed quite a bit in that space of time. I no longer believe buying a stock at any price is the right thing to do. Buying this stock at $181 per share meant I had next to no margin of safety from my calculations of Apple's intrinsic value. I was willing to forgive this originally because it's Apple, and its high performance in the past justifies owning it in my mind at the time. This is because the business model has outperformed and makes up 50% of Warren Buffett's portfolio, so in my mind it could be bought at almost any time. But the expected growth rate of Apple's revenues is exceedingly low for the next couple of years, and I think it will outperform this level of growth maybe, but I don't believe it will be able to justify its current valuation without a lot higher top line growth. They may get this from an innovative design in the future, but for now I've chosen to wait for a better buying opportunity that offers a better margin of safety for this stock in particular. Which is what I should have maybe waited for when I started this position. I wasn't up 100% or so like some other investors are in this stock, and if I was, I would maybe consider holding it because the compounding effect of those buybacks would actually be more beneficial to me. So I sold the position with a very small gain. What's quite funny about this sell that I've done last week is that I'm now hearing reports that Berkshire Hathaway have now reduced down considerably their Apple position by about 13%. And that's something that I didn't know anything at all about when I sold out of my position entirely. So it's quite strange that it suddenly happened, and I'm having to actually re-record this part of the video so that I can put this part in. So I didn't know anything about that, and I'll be very curious to hear the reasoning that Warren Buffett and Berkshire Hathaway have for selling out of this position, and whether that actually lines up with my line of thinking with Apple at all. So now we have my loose reasons for selling this stock after Apple's earnings, which the market actually found quite favourable. What did I actually use the funds to buy? Well, it was between three different stocks, one of which was MSCI, which has had a big share price drop after earnings and is currently down over 20% in the past 3 months. I think this is a very high margin and quality analytics company that has proven very profitable and wasn't too concerned with their loss of retention and slightly weaker earnings report in Q1. Its free cash flow is growing predictably, and it has a low payout ratio and good dividend growth. Then we have Visa as our second contender, down around 3% in the last 3 months. I love this one and already have a substantial position in it over £2,000, and with a weighting over about 11% in the portfolio itself. More recently, I think Visa has entered the buy radius for me below the $270 mark, because it's a compounding free cash flow monster of a financial company that has the best margins in the world. And every time I use my Visa card, I love that I'm a shareholder of this company. And the share buybacks and dividend growth this company offers is both predictable and explosive. So I really wouldn't mind doubling down on this position, but wasn't sure the price was just quite right to do something like that. And then we have Salesforce, the customer data and software company that recently announced a new dividend and share buyback program. Shares of Salesforce are down around 10% for the month and up over 37% for the year. So it's already fairly run up, but has had a slight pullback recently due to concerns about acquisition talks with the company Informatica, with the shares seeing that 10% dive. So which one did I choose? Well, it was Salesforce, and let me go over the reasons why. I've wanted to own a stock that focuses on subscription-based software for companies for a while. It's the reason I started a position in Adobe a while back, and the reason Intuit is still on my watch list. They are highly profitable due to margins and predictable in free cash flows because of this business model. The model itself is subscription-based customer relations management business, and they're the number one in this space in the world. Where Salesforce stands above the rest is because its big moat with an established ecosystem of services that improve companies' experience for customers through data. The reason I see the competitive advantage in this type of business is because it allows many businesses to form from using the data they've already collected and creating further software and platforms that companies will be willing to pay subscription-based revenue to own. In its lifetime, Salesforce has acquired 12 companies and incorporated them as part of their business. They have otherwise been somewhat wasteful in their money, making large-scale purchases of paid celebrities or companies they didn't always have to buy. With the announcement of this new dividend, with its low free cash flow payout ratio sitting around 13%, I would like to see this growth in the double digits in the future, and the buybacks in their shares to increase my stake in the company as a whole, rather than buy companies that they really don't need to necessarily own to grow organically. One of the reasons to buy this company over the other two is their 2025 guidance. They said they would grow their operating free cash flow by 21 to 24% in their more recent earnings report. Now, they did this in 2024 by 44% year-over-year growth. So I think for this sort of company, this is actually something that is achievable. This beats out MSCI and Visa's operating cash flow guidance for that year. And with the stock currently down 10% for the month, it actually presents a bit of a window of opportunity, if you ask me. So what's the actual company worth itself? I calculate its intrinsic value from my DCF model and a few others around the $400 mark. That's with conservative guidance on the growth of that free cash flow over the next 5 years or so. So I opened a position in my Trading 212 account, buying a little over 10 shares at a value of £2,223, which was bought at a $274 per share mark, which gives me, if my valuation is correct, a margin of safety around 30%. I think if they can deliver on their guidance for operational free cash flow, then this is one that could actually do very well indeed. The company itself actually makes up a weighting now of about 12% in my portfolio, with my current value sitting over £18,000. Anyway guys, that's it from me. Feel free to let me know what you think of this new buy and any stocks that you've actually recently bought, and I'll happily reply. Best of luck with your investing, and I'll see you in the next one.